First of all, hello, everybody. My name is Alex. I am a reporter and a bit of an editor at TechCrunch. Very happy to be here. Thanks to Startup Grind, of course, for having Fredrik and myself out. As a general note, I was told we'll be taking some audience Q&A as we go. I know we're dealing with some technical issues, so I don't know where those questions will come up, but we will, of course, try to get to as many of those as possible. And I was going to say, before Fredrik and I got started, that we're dealing with a cross-ocean internet connection, so there could be a little bit of lag in our video, but I don't think that's going to be an issue for the short term. So with all of that throat clearing away, a big welcome to Fredrik Cassel from Creandum. Fredrik, how are you doing?
Alex, thank you so much. Doing very well. And as I mentioned, I mean, very happy to not look at my face on the screen again. So let's hope we can make this work either with or without video.
Yes, well, I think that this sort of get together is a great use of technology during this relatively interesting time, especially here in the US where I am, because we are dealing with rising levels of COVID, whereas I think you all in Europe are doing a bit better. But let's put aside the pandemic for now and talk a little bit about your firm and its most recent fund. I was prepping for our chat today, and I saw that you guys put together, at least if research holds up, a 265 million euro fund back in 2019. And I was just kind of curious about the size of that fund, because it struck me that given your fund track record, your firm track record, you could have raised a multiple of that amount. And so I was kind of hoping you could tell, not just myself, but our audience here, why you guys didn't pursue a larger vehicle to make investments for your current fund.
Yeah, I think it's a great question. As I think many of you in the audience know, this is a balance where the trade-off as a venture investor basically is that the larger the fund gets, the harder it becomes to take really early stage bets and take really early stage risk. And if we look at the sequence of Creandum funds, they've increased. The first fund way back 20 years ago was 30 or 40 million euros. So this is a significant step up from that. But we've tried always to stay true to what our roots are, which is basically trying to do Series Seed and Series A, and exclusively that, and try to do around 30 investments per fund. And basically it's always been half seed, half Series A.
Now, I presume the fund size has gone up throughout time because seed and Series A rounds themselves have become larger. So if you'd like to still lead them, you had to have more capital on hand just to pursue the same investment strategy over time.
I think that's absolutely right. And even though maybe the increase hasn't been 10x like our fund sizes, I think we've also widened the geographic scope. When we started, it was very much a Swedish or a Scandinavian thing, whereas today we cover the entire European continent, actually even a little bit of the US. So also from that point of view, the number of deals is higher, and as you said, right, the rounds are just in nominal terms bigger.
Yeah. I want to ask one more question about the makeup of your kind of investment vehicle, because I always find these to be very interesting because they explain a lot about a firm's philosophy. You guys, to my knowledge, haven't put together an opportunity fund or a kind of secondary later stage fund. Many firms in the US that I've seen have been doing this just to let them double down on their best deals. I was kind of curious about the philosophy behind keeping yourself to one main vehicle. Is it a focus question? Is it you want to stay true to what you know? Why that choice?
I wish I had like this super punchy answer that, but you're actually it's a very relevant question, and I think maybe just a short anecdote. The question of raising an opportunity fund, I think, comes up for every venture fund manager every 2 or so years, if they haven't already raised one. If they haven't already, it's up for discussion every 18 months. You have this portfolio of fantastic companies, and you feel that you could make use of more money and invest in those winners. And when I last sat down with the folks over at Benchmark in San Francisco, which I actually think run a firm which is in many ways representative of a firm that we'd like to run as well, in terms of focus, sure, and in terms of partnership and in terms of trust, both amongst the people working in the firm, but also between investors and entrepreneurs. I was just saying, when even the best fund on the planet don't seem to have a real strategy for how they use their pro rata rights, which is what we're talking about here, giving away the upside, potentially giving away the upside of continuing to invest in your winners to others. When even the best fund in the world, which I think it is, really doesn't care so much about it. I felt, okay, maybe this isn't, maybe it's a pretty good strategy to be and keep being very good at what your core strategy is. And for us, that's always meant, focusing on seed and Series A. And I think for the time being, that's where we're going to continue to spend most of our time. And, it's also, we'll get back to this, Alex, but as everyone on this call or webinar knows, it's also an increasingly competitive environment out there. And I think every time spent doing something else than trying to back the best entrepreneurs in the very early stage, it risks diluting and risks basically jeopardizing your chance of winning the best deals.
Yeah, and then in defense of what you guys have chosen to do, it's not like your returns haven't been quite good. You are on your, I believe, 5th fund or something along those lines. So the model has historically worked rather well. And in that, I was doing some research on how you guys approach the market, and I think a partner at the firm, Johan Brenner, said that you guys were, quote, quite agnostic about the industries you focus on. And this struck me as pretty interesting because often we see firms focus on kind of one particular niche in the startup world, one particular type of company. You guys have taken a more broad, almost generalist approach to it. I'm curious if you guys still hold true to that philosophy today, or if you're beginning to specialize more as you pursue an increasingly broad array of startups focusing on so many different things out there.
I think our combination is one which is it's a hybrid. Like there's some we just can't shy away from certain areas or certain sectors of innovation where we feel we need to lean into this one and build knowledge ahead of the curve and try to be aware ourselves of what it is that we're looking for and then go out and actually try to find that. So it's something that we've done historically within certain sectors. We did it early for crypto and Bitcoin. We did it very early for digital health. And for some areas, it's going to continue to be like that. We're going to make initiatives like that. But I think it's never going to take away the basic sentiment in our firm that if someone comes in, like Daniel and Martin did with Spotify back in 2007 and pitched an idea which seemed crazy, and where the consensus was never to put any money at all ever into digital streaming services.
Right.
If we had a too predefined view of the world back then, I think we would never have backed those guys. And maybe the same thing would have applied to Vivino, which you will be talking to later on. So I think there's this, we need to strike this balance where we need to be open-minded and maybe let the best entrepreneur convince us to back even the craziest thing on the one hand. And also on the other hand, when there's sort of mega tech shifts or trends that we really want to get behind, we have the resources now to lean into those and be more proactive.
Gotcha. I think Marion's doing the Vivino chat. I think I'm in the audience for that one, but I want to dig into this idea of non-obvious bets because it's everyone likes to claim that they can go out there and see what other people aren't seeing. So I'm curious, from your firm's perspective, what are the signals that you're looking for in companies that might not fit the current, venture consensus, if you will, that really give you guys the conviction to make either a seed or a check that other firms are kind of backing away from, hiding from, or just not really leaning into as much as you guys have been?
I think we've always been product centric in the sense that, and also like we're a group of 10, 12 investment professionals. So it means that even though the firm has an idea, it comes down to the individual, and we're all different individuals, which I think is a strength. And we like to reinforce that with each and every one of us. Like I love the fact that there are deals that my partners go after that I wouldn't actually spend too much time with. I think is actually a pretty exciting thing. So I think there's a diversity, between the individuals involved. But I think what you'll find in common, which was your question, is we really look for something in the product, some kind of spark that the product has with its users. And with consumer services, that's that oftentimes is pretty obvious. You can see that from even a very small set of data, looking at just 100 or 1,000 users, you can oftentimes see that, like people come back, they engage, they lean into the experience. It's a little bit trickier with early stage B2B software even for smaller businesses. But as the tech stack has evolved, it gets easy also there. But I think if there is a spark, if there's a promise that this company can go somewhere without spending massive amounts on acquisition marketing or massive amounts on building up a sales team day one, there's something else in there. I think the entrepreneur has got our attention.
So I want to talk about the Spark idea. Are you just kind of rebranding the idea of product market fit, or is the Spark that you're searching for something that almost comes before product market fit when the company is even more nascent, and therefore maybe it looks a little bit different than PMF might in a later stage startup?
Also a good question. I think actually the product market fit isn't it's not a fantastic concept, because in many cases it involves product equals something that can be sold. So in much literature that's been written around product market fit, equates a product with something that can be sold and that someone has paid for. And as soon as someone or many people have paid for it, it fits the market. And I think that's not perfect. I mean, we for us, if it's about engagement, if it's like we can see that there's engagement, I think we can get over many of the monetization risks. But if we see that there's real engagement, and in some cases that comes much earlier than monetization. So I think where there is engagement, we're excited.
So you're much more interested in, for example, picking TikTok, because everyone's talking about that these days, at least in the US. People open TikTok like 100 times a day. So that's the kind of spark you'd want to see in an early stage consumer application ahead of monetization data. But you want to see people just not being able to get enough of that app or service or product or whatever it is the startup is trying to build.
That is one example. And the audience will hear more about Vivino, which is another such example. And Spotify is a third one. Yep. There's several of those. And you're right.
Okay, so I want to flip this on its head, because being a firm that has a large focus from crypto to health and to a lot of things that I find very interesting, I'm curious if there are sectors that you just will not invest in. Are there startups or startup types that you just are not interested in as a firm whatsoever? Because I know entrepreneurs are going to be hearing this, and I'm curious, don't waste their time or yours.
Yeah,
where are you not going?
The venture capitalists, just getting the perfect chance to not get deal flow from the audience here. So I'm going to watch my tongue a little bit. But I think it's true that there have been many other firms that have been more ambitious and more successful in investing in pure play e-commerce than Creandum. If it is sort of generalist e-commerce that is based more on out executing others and outbidding others on sort of an acquisition marketing war, I think there have been many other firms that have been more successful and also more active than Creandum. I think that's if there's any field where we haven't really felt so engaged, that's probably one. But that doesn't mean that we haven't invested in things that deal with electronic commerce. Like one of the big winners in a fund not so long ago was a company called Cornershop, which basically runs the Instacart model in South and Latin America. Phenomenal business, but that one is more about demand aggregation. It's about providing an interface to users that they love, and also a service and fulfillment and quality on the back of that. That makes the service and the experience something more than sort of Googling for the lowest price of a home appliance.
So listening to you say that, there's areas where you're not as focused as a firm, you don't have as many eyes on the ground, but there's no place where you're going to say, absolutely not. There's nothing there that's interested in us and we're going to avoid it entirely.
I don't think so.
Okay.
I don't think so.
No, that's very interesting. I mean, it's kind of refreshing, actually, because many people say, we're only doing vertical SaaS for the next fund. And that's very, mono, it's a little boring to hear. So I'm glad to hear that you're actually thinking relatively broadly. But let's think about the world in two halves. There's roughly B2B focused startups and B2C focused startups. And one thing that happened last year that I was very surprised by was that the balance in kind of global seed rounds switched from B2C to B2B, and B2B rounds became more popular. And in the data that I'm seeing from kind of the US VC scene and the European VC scene, there seems to be a really strong push towards B2B startups. And I'm curious, for Creandum today, are you guys trying to strike a balance between the two kind of main halves of the startup world? Are you more focused on one? Where is your attention more focused on, B2B or B2C?
Great question. I again back to maybe the diversity of the team. I think historically we've been 50-50. It's not been by design at all, not the least. I mean, outside of the design of the team, there hasn't ever been a discussion around, have we done too much of this or too much of that? But coincidentally maybe, or as a reflection again of the team, the people involved, it's been 50-50, business focused versus consumer focused. There hasn't been much change in our case over the last 12 months, I have to say. But I think it's true. It's true that the business side of the business half of your world has also changed, because the last 10 years has meant, a revolution almost in the way that software has been, in the way you can go to market with software to companies and enterprises. 10 years ago, there wasn't such a thing. There was MySQL who grew from the grassroots and up, but any other software basically had to employ just hordes of salespeople and sell it very manually. But the last decade has seen a lot of change in that, and I think the change has maybe been strongest in the small and mid-sized segment of the enterprise community, which is one where we've leaned in heavily. But we still label that as a business, as the business half, right?
So listening to you say that, it sounds like kind of like SaaS and the ability for sales to go bottom up in organizations has made that sufficiently attractive as to maybe change VC's focus to be a bit more on the B2B side than on the B2C side. Does that mean we can kind of blame Dropbox and their old sales model for what's happened in how much money people are putting into SaaS today?
Yeah, I guess Dropbox has. I mean, there are a couple of examples around Dropbox. One is that they did show in the early days that there was a path to market that didn't involve a sales force, but
Yes.
they also showed that in order to get a real substantial business, you needed a sales force. So I guess it's not exactly I think the message is still that you can get a long way with a product that resonates with users, and you can also get, revenue-wise, you can get a long way with that product. But sooner or later, you will have to excel also in sales and marketing. Perhaps though, that point in time is much later than it was 10 years ago.
I got it. I don't know when we're going to get cut off, so I want to make sure I get to this next question before we're asked to be quiet. I've been talking to a number of seed-focused investors in the U.S. about what's been going on in the pandemic and how that has impacted certain startups' growth rates more than others. And I wanted to hear about what's going on in Europe, which you have a much better eye on than I do. What I'm hearing is that there's kind of like two groups of startups. Those are those that have been accelerated by the trend, by the pandemic, that they're selling remote work tooling or their software is now more in demand, their growth rates are more impressive. And then there's kind of everyone else. And if you're not growing as fast as you were, or you're kind of flatlining, the message that I'm hearing, sad to say, is that VCs are kind of pulling back from those firms entirely. So I'm curious, is there a similar kind of bifurcation of the startup world in Europe as you see it today?
I don't think it is as dramatic or as black and white in Europe. I'm not as tuned into the US landscape, but in Europe it certainly isn't as black and white. I guess there's this fundamental problem. If your business is tanking, it is just incredibly hard to get an outside investor excited. So like there is that, of course, but then I think. I think there's been incredible momentum around a lot of businesses who aren't exactly, being pushed ahead by the pandemic situation. Maybe, I think all of them will have a business momentum that's been, if not increasing, at least relatively persistent. But I think there are plenty of those. There are plenty of those across many segments today. So I think, and I think we've seen in Europe, we've seen a lot of good, solid deals being done across the range, like both targeting, that segment that I mentioned, the small and mid-sized companies that have been on a large scale suffering a lot, but also then of course companies that are sort of smack in the middle of something that's being pushed ahead by the pandemic, such as digital health or remote work or meetings, as you mentioned.
Mm-hmm. Well, you guys just put money into a company called, and I'm going to butcher this, I'm sorry, Fredrik, Metatopia. I think that was announced today. And that's an
right.
example of a digital health service that's doing, I presume quite well. I'm curious what attracted to your firm to that company and why you were so willing to put so much capital into it compared to how much it had raised before. It's a $15 million round.
But this is another example of a company that has, they're not exactly alone in the market for, let's call it meditation assistance. But the way they have managed to localize their offering and the way they're growing in markets where some of the names that we've heard before haven't been so successful is something that really struck a chord with us. So it's not only about understanding the product on sort of on the abstract level, it's understanding what actually does resonate with the Brazilian users or with the Turkish users. And these markets are pretty big. And this also comes back to the team. They are, they're one of the stronger teams that we've come across when it comes to understanding their users, building their next product iterations on data. And the fact that they raised little money before is more an effect of their cost-efficient way of growing their business than anything else.
Yeah, I was very impressed. They raised something like $3.5 million before this round. So they now have more capital than they've ever had before. So I'm curious to see how fast their growth rate can accelerate with this kind of infusion of new capital. It's going to be a fun one to watch. We've been given 5 more minutes, so I have 2 more questions I want to run past you. Thinking about the entrepreneurs that are going to hear this, I'm very curious to see what your take is on what a Series A deal kind of requires today. And I know every startup is different and every vertical is different, but there were some metrics a couple of years ago that people kept in mind for seed stage companies looking to raise an A. And I'm curious from your perspective, maybe not what metrics per se, but what benchmarks are kind of the de facto standard now in the European scene to raise an A from seed stage?
Yeah, I think the good news for the people on this webinar is that there's more money available than ever before, like literally than ever before, and there are also more flavors of investors around now than ever before. There are investors who are leaning maybe more on sort of a little bit less ambitious. Sorry, not ambitious is wrong English word, but a less stratospheric ambition for the growth of their businesses, and maybe thinking more about sort of preserving capital and being capital efficient. And there's still those that are just looking to max out growth at all costs. And a little bit depending on who you're meeting, it's going to be a little bit of a different reaction to the metrics or to the way you describe how your service fits the market. But I think if we look at a Series A, it's a company that can talk intelligently about their customers and their users. They've used their angel and their seed round to understand what it is that their product brings to users. And these are more than just random users. This is a user group that is slightly more established. Sure. And they've got early signals of ways they can scalably grow that user base or customer base. Series A is still by no means the point where you have proof of scaling. So most of the bets on the go-to-market machinery is still ahead. And I think that's held true for the most of my career, 17, 18 years. I still think it's true. Now, what we haven't talked about is, there are pretty big Series A rounds now baked together in companies with no product or with just an embryonic product and like nothing to show for in terms of engagement metrics or these other things that we talked about. And I think that's also a reflection of the European ecosystem being a little bit more mature. There being a little bit more groups of second or third time entrepreneurs that you as an investor can get behind without too many tangible proof points of what it is that they're building. You can actually get behind this team or this group of people building something that's truly amazing. And the leap from investing a lot of money on just a concept has become a little bit less dramatic. It was I mean, for the last 20 years, that's been happening for good teams in the US. And I think we're seeing more of that happening in Europe as well.
How big does a Series A have to be to kind of meet that threshold for you? Are you thinking about like a $15-20 million Series A, or is it more like 50 on a more nascent product to kind of meet that same category that you're describing?
That's probably a little bit more than just a 50 million round, but certainly if you're raising a Series A of 25 or 30, you're probably
Sure.
in the category where you probably don't always have the metrics justify that kind of amount.
Yeah, I want to squeeze in one last one before I let you go, which is in the current economic environment, many large corporations are still very cash rich, and they have large accounts, and they're hunting for maybe startups to buy, teams to pick up, that sort of thing. Are you seeing an uptick in M&A interest from larger companies towards your portfolio and other companies in the startup ecosystem around the EU?
I think it's been picking up the last 5 to 10 years. I think the number of companies in Europe that realize that a path to well, just a way to continue to exist is to enrich their innovation base with outside talent. I think that awareness is today so much more prevalent than it was 10 years ago. I think it's always been core to the US ecosystem, and I think it's becoming much more clear in Europe. I do think that the COVID and the pandemic situation has certainly throttled that a bit, but I think in terms of like the general trend, absolutely is there. I think for founders and also for investors, it typically means that instead of a company not doing phenomenally well, instead of getting zero back, you can still make a big buck, like a 3 to 5x, and as an entrepreneur you can really you can settle down if you want to with a less even with sort of a medium outcome. And I think that, like, the, how should we say without sounding the takers in that segment have just multiplied by many times.
Well, we could go on for another hour. I want to talk about pre-seed. I want to talk about the UK. There's so much to go on, but we have to stop. But Fredrik, thank you very much for your time, and thanks to Startup Grind for having us out. We're going to hand this back now to Marion. But lovely to be here, and I hope everyone does well.
Thanks, Alex. Thanks, Startup Grind.